All right, let's talk about something that's at the absolute heart of business and investing. We're going to get into what it really costs a company to get the money it needs to operate and grow. So let's just dive right in. It really boils down to this one question, right? For any business, you've got a bunch of ideas, a bunch of potential projects. How do you separate the real winners from the ones that are just going to burn cash? Well, the answer, it lies in understanding the true price of the money you're about to invest. Okay, first thing you have to get your head around is this. Capital, the money a company uses to fund everything. It isn't free, not even close. You should think of it just like any other resource, like labor or materials. And just like those things, it's got a price tag. So what is this price? We call it the cost of capital. The simplest way to think about it is as a hurdle rate. It's the absolute minimum rate of return a company has to earn on a project just to keep all its investors, both the people who loaned it money and the people who own it, happy.
Think of it this way, right? It doesn't matter if you're buying a new factory or just funding a marketing push. The capital you use to do that comes with an expectation attached. There's a price tag on that money, and you absolutely need to know what that price is.
So where does a company get this money? Well, generally speaking, it comes from two main places, and each one has a totally different set of rules and expectations.
And the difference is pretty huge. On one side, you've got your debt holders, your banks, your bondholders. They're lenders. They have a legal contract that says they get paid back with interest. Because their risk is lower, they're happy with a lower, more predictable return. But then you have the equity holders, the shareholders. They're the owners. They take on way more risk, but in return, they get a claim on all the profits left over after the debt gets paid. And because they're taking that bigger risk, you better believe they expect a much higher potential return. This image here, yeah, it's got some Spanish, but it shows the idea perfectly. You've got money from debt, that's deuda, and money from equity. And it all gets mixed together in one big pot to pay for the company's assets, the activo. But here's the key. Once that cash hits the company's bank account, it's all just money. You can't tell which dollar came from debt and which came from equity. So because it's all one big pool of capital, you need a single blended cost for that entire pool. Now, this is a really important point, and it's one that trips a lot of people up. It's easy to see the cost of debt, right? It's the interest payment you have to make. But what about a company that doesn't pay dividends? Is that equity capital free? No way. As this quote says, not paying a dividend just means the profits are being plowed back into the business to grow it even more. Those shareholders still expect a return on that reinvested money. They just expect to get it through a higher stock price down the road. So, how in the world do we figure out this single blended rate that takes into account both the cheaper debt and the more expensive equity? Well, that's where a little something called the weighted average cost of capital, or WACC, comes into play. I know, the formula might look a little intense at first, but the idea behind it is actually pretty straightforward. All you're really doing is taking the percentage of your funding that comes from equity and multiplying it by its cost, that's the KE, and then adding that to the percentage that comes from debt multiplied by its cost, the KD. See? It's just a weighted average.
But wait, there's one more really important piece to this puzzle. The interest a company pays on its debt, well, that's a tax-deductible expense, and this creates what we call a tax shield, which actually lowers the real cost of that debt. That's why in the full formula, you see the debt part gets multiplied by 1 minus t, where t is just the company's tax rate. It's a pretty big advantage for using debt.
Okay, so we've gone through the trouble of calculating our WACC. Now what do we do with it? Well, this isn't just some number for a spreadsheet. This number becomes one of the most powerful tools a business has for making smart decisions. Here's the bottom line. The cost of capital is your benchmark. It's your hurdle rate. Any new project, any new investment, any acquisition you're considering must have a projected return that is higher than your WACC. If it doesn't, it's not even covering the cost of the money you're putting into it, and you are actively destroying value for your investors. Let's play this out with a quick example. Imagine your company's true WACC is 10%, but you make a mistake and you use a lower rate to evaluate projects, say 8%. So you look at a project that's expected to return 9%. Using your faulty 8% rate, the math says the project looks good. You get a positive value and you give it the green light. But what did you just do? You invested in something that doesn't actually clear your real 10% cost of capital. You're losing value. And of course, you can make the opposite mistake. What if you use a rate that's too high, like 12%? Now you're evaluating a perfectly good project that's going to return 11%. Because your hurdle rate is set too high, the math comes back negative and you reject it. You just walked away from a project that would have made your investors richer. Getting that WACC right is absolutely critical. Okay,
Let's add a layer of complexity here, because this is really important. What if you're a big, diverse company? You have some business units that are really risky and some that are super safe and stable. Can you still just use one single whack for the entire company?
So let's imagine a company we'll call Life Inc. It's got two totally different divisions. First, there's the risky division, maybe a high-growth tech venture. It's risky, so its true cost of capital should be 15%. Then there's the boring division, a stable, predictable utility business. Its cost of capital is much lower, only 10%. If you average them out, the company's overall WACC is 12.5%.
Now here's the trap. If the bosses at Life Inc. use that single 12.5% hurdle rate for both divisions, they are going to make some terrible decisions. They'll look at a 13.5% return project in the risky division and say yes because it's above 12.5%, even though it's actually below that division's true hurdle of 15%. At the same time, they'll reject a solid 11% return project in the boring division because it's below 12.5%, even though it's well above its 10% hurdle. They end up over-investing in their risky business and starving their safe one.
The takeaway here is pretty clear. You have to match the discount rate to the risk of the actual investment. You should figure out a unique cost of capital for each distinct business unit, almost as if it were its own separate company. That's the only way to make sure you're making a fair comparison.
All right, to bring this all home, let's flip the camera around for a second. Let's look at this from the investor's point of view. Why do they demand these returns in the first place? Well, it all comes down to one of the most powerful concepts in all of finance: opportunity cost.
See, an investor's required return isn't some number they just pull out of thin air. It starts with a risk-free rate, what they could earn on something incredibly safe, like a government bond. Then, on top of that, they add a risk premium. They are basically asking, okay, if I take my money out of that safe bond and give it to you, with all the extra risk that entails, how much extra are you going to pay me for it? At the end of the day, the cost of capital is just the return an investor could get somewhere else on an investment with similar risk.
So you see, the cost of capital isn't just some academic number. It's the market talking. It's the blended voice of every single investor who funds the company. It is the ultimate judge of which ideas are going to create wealth and which are just going to destroy it. So the only question left is, how are you going to use it?